Welcome, everyone, to United Church Fund's Town Hall webinar. I'm Charles Buck, President and CEO of United Church Funds, or UCF. And I want to thank you for taking the time to join us today, and also to thank you for trusting us to be your partners in stewardship. We take your trust in us seriously, and we live out joyfully our mission of supporting your mission. For nearly 3 years now, we've been hosting these quarterly webinars to keep you updated on the latest happenings at UCF and the markets with your investment portfolios. And if ever updating were needed, it's definitely now, following a very highly eventful, probably historic second quarter. Of course, we know about the market or capital markets as of June 30, the worst first half of the year performance in 4 decades. There were challenges of persistent inflation, rising interest rates, supply chain squeezes, and ongoing war. And as if all that weren't enough, in the last week and a half of the quarter came some broadsides from the U.S. Supreme Court. 3 decisions that directly impact our responsible investing work at UCF. We're all familiar with Dobbs and the overturning of Roe v. Wade. At UCF, of course, one of our priorities is women's reproductive health, including abortion rights. The second, days earlier, the court overturned a New York State century-old law against carrying concealed handguns. At UCF, we screen out gun and weapons manufacturers from our investments, and we're strong advocates for gun control. And third, in one of the very last decisions of the season, the court ruled that the EPA overstepped its authority in regulating power plant emissions. That and the prospect that this decision could limit the power of other federal administrative agencies, such as the SEC or the DOL, that's a huge blow to the climate action movement, among others. And climate action, of course, is one of UCF's highest engagement priorities. So, eventful indeed, but at UCF, with 100 years behind us, we're not about to give up. We're in the long game. We're constantly adjusting strategy, and we'll persist in our mission for the sake of your mission and for the sake of God's mission. So, lots of updating to do on the agenda. On the next slide, we're going to start off with Matt Wagner, our Vice President of Institutional Relationships, telling you the latest goings on at UCF. Then our Director of Responsible Investing, Matthew Illian, will share what's happening with our ESG work, including some excitement at a shareholder meeting. The remainder of our time will be devoted to market and portfolio performance with Matt and Stacy Pettis of our institutional relationships team in dialogue with our contracted investment team from the pension boards, Dave Klassen, Lon Kai, and Minoti Dhanaraj. Well, before we go to Matt, I want to first publicly thank our marketing communications team of Debbie Wibo and Adam Sank for making these webinars happen. I have to do the shout out because you will actually never see them. That's how good they are. But I assure you, like the spirit, they are with us. They're all around, under, behind, beside us. Thank you, Debbie and Adam. So Matt, I will turn it over to you now.
Charles, thanks so much thanks for introducing not only our organization, but also our mission. And I want to thank everyone on the call for joining us. I see, as I'm looking through the participant names, a lot of familiar names and also some new names. So if you've joined us for these webinars before, we want to thank you for coming back. And if this is your first one, we want to welcome you to this resource that we provide to all of our clients quarterly. And we hope that you find this time helpful and useful as you navigate these volatile waters that the markets have given us over the last handful of quarters. Just a couple of quick organizational updates from our team before we dig into sustainable and responsible investing updates. Our team is excited to announce that later this year, we will be offering a newly formatted performance and account statements to our clients, as well as a new online client portal. More details are coming, but we are excited to be able to make this announcement. Our client services team, which many of you, I'm sure, interact with on a regular basis at UCF, have been attending trainings weekly, who've been doing a lot of work behind the scenes to prepare our organization for this significant change and what we believe will be an upgrade in the overall client experience. I want to publicly thank our Director of Finance and Administration, Karen Sherman Chang, as well as our Client Services Team Leader, Millie Hernandez, and our Client Services Team, Harsha and Krista as well, for all of their work and all of the work that they will be putting into the coming months to prepare our organization and our clients for this important changeover. One of the areas at United Church Funds that we are quite proud of is our commitment to diversity, equity, and inclusion. And over the last couple of years, we've looked at ways in which we can enhance that commitment. One of the ways that we saw that we could do that was by working directly with our existing investment managers, as well as we hire new managers, look to hire managers that are specifically from historically underrepresented groups with a focus on Black-owned or Black-managed investment managers. This has involved a deep dive into due diligence of our existing managers, as well as we seek to hire new managers to and help inform our team about their commitments to diversity, equity, and inclusion. You're going to hear more from us on this topic in the coming months, but certainly wanted to make sure that you knew that we are taking this commitment seriously, and I think taking it to a new level. And we're excited to be able to share that story with you. In Q3 2022, as the impacts of the pandemic start to wane slightly, hopefully, fingers crossed, the institutional relationships team will start the process of getting back out on the road and meeting with our clients in person. We have done that on a very limited basis over the last 2 years. And in fact, even our own board at United Church Funds has not had an in-person meeting since 2019. We're excited to be able to get our board together in person in Montgomery, Alabama in October of 2022. And our institutional relationships team will be starting the process of scheduling in-person client visits again in Q3 2022 and beyond. And then finally, we just wanted to bring you an update from our partners at the national setting. They'll be hosting a UCC summit to talk about how our denomination can be a powerful and impactful organization as we look post-pandemic, and excited to be able to help them promote this summit, which will be September 19th through 21st. We encourage you to go to ucc.org/events to be able to register for that event. And you can see other events that the national setting is hosting to benefit clergy, lay leaders, and others who share our commitment to social justice and fighting racial inequity and climate injustice, among other topics. And speaking of sustainable and responsible investing, I'd like to be able to introduce now my colleague, our Director of Responsible Investing, Matthew Ilian, who will be sharing some updates from his area of our organization. Matthew?
Thank you, Matt, and thank you all for your participation. It's good to know what's top of mind for you, our clients. The first topic I want to cover is an investing topic that has been increasingly showing up in media and in the political realm. It's ESG. What is ESG? Well, a definition here that we recommend are factors, business practices that historically do not show up on financial statements, but offer material insights. So the E is for environment. This includes data on climate emissions, water usage, industrial disasters. The S stands for social factors, including employee satisfaction, supply chain, workers' rights. The G stands for governance, board of director composition, executive pay, proxy voting practices. So taken together, the ESG we see, and the industry increasingly sees, as a more comprehensive view of a firm, of an organization, than the financial statements can offer. You'll see the note at the bottom that of this slide that ESG is not the same as divestment. We have many clients who've chosen to divest and that use our Beyond Fossil Fuels funds, but we have others who don't. And yet the ESG factors are used by our managers across all the funds. So you'll see in the next slide how much ESG factors and interest has grown. In fact, since 2012, we've seen a massive growth in ESG, and it's estimated now that 1 in every 3 institutional dollars at pension plans, at retirement plans, at trust plans and endowments like UCF are using ESG metrics in their management. And so, for the last 10 years in particular, it's been nothing but positive news. particularly for those who've been doing this work for 50 years, to see how much interest there is in off-balance sheet factors. However, all good things must hit some resistance at some point. And so, and particularly in the political realm, we are seeing some resistance to the growth in ESG. And you'll see this map lists the states where 9 states have actually passed ESG bans, limiting their state pension plans and treasurer's offices from using ESG metrics in the management of the funds and working with managers that incorporate ESG. 6 states have are in the kind of discussion and evaluation of these ESG bans. And so, you know, there's a lot that's behind this, but I think some of the biggest factors is that that ESG has been kind of described as leading to, you know, sort of an anti-fossil fuel movement, that it's been leading to woke capitalism and this idea of, you know, increasing diversity in boardrooms, et cetera. There's kind of a pushback in the conservative media in particular against ESG. But we think this is probably some good sort of healthy resistance winds, not a hurricane, and that ESG will survive. Although one of the more humorous attacks on ESG is in this next slide, came from Fox News columnist Tucker Carlson, who in the Warning to America said, this is about a month ago, talked about how ESG is hurting the Sri Lanka economy. In fact, it tanked, how ESG has destroyed Sri Lanka. So, you know, that's on the humorous side. But if you know Sri Lanka, it's an emerging market. It's had lots of resistance, or the COVID-19 shutdowns have hurt the economy. Inflation from the war in Ukraine is also, you know, creating lots of resistance in the economy. And it doesn't help that one of the anti-government activists in Sri Lanka, his name is Joseph Stalin, in fact. But all to say that ESG is the least of the concerns in Sri Lanka, and we do believe that that the problem with these bans is that it's actually tying the hands of the asset managers who would have access to a whole lot more data about companies if they were able to use ESG metrics. This is not to say there hasn't been some excess in the uses of ESG and the promoting. You know, you've heard the term greenwashing. And we've seen recently some the SEC come out with proposed regulations against companies and fund management companies that are using ESG in their marketing without having it in their investment strategy. And this is exactly what regulators should do in an evolving marketplace, is they should you know, protect particularly retail investors against excesses, against marketing that doesn't deliver the results. And so we're glad to see this. We think this is a part of a healthy, maturing, evolving marketplace. One of the biggest reasons why we know that ESG is not going away is because of its support of investment returns. And you'll see in this slide here that there's 2 indices or index or benchmarks that are being highlighted. The top index benchmark is the MSCI World ESG Leaders. And below that is the larger universe, the MSCI World, which includes virtually all of the investable stocks around the world. And MSCI has been keeping track of the leaders versus the unmanaged benchmark since 2007. So we have about 15 years of data. And you can see, going back that time, that in fact, the ESG leaders have a slight advantage of a 5.21% average annual return versus 5.11. Now, we're not going to sit here and argue that ESG is this panacea of alpha and it's always driving superior returns. In fact, we see some on years, some good years and some slightly underperforming years. But the important fact here is that this should dispel the myth that ESG leads to underperformance, which is one of the biggest attacks that have been made against it. In fact, there's a good reason to believe that it will continue to help in the analysis of companies, and particularly has been helpful in downturns in the market. And so that's another reason we expect ESG factors to continue for the long term. So that's the quick ESG update. I now want to turn to the part of my presentation that I'm most excited about. I spoke a couple of weeks ago with Gabby Bolden. She's a labor activist with Step Up Louisiana, and United Church Funds had designated Gabby as our proxy, our legal proxy at the Dollar General shareholders meeting in Goodlettsville, Tennessee, on May 25th. Just for a quick background on Dollar General, their annual report boasts that they are the most prolific retailer in the US by store count. They have over 18,000 stores, and that they cover approximately 75% of the US population is within a few miles driving distance of Dollar General. So we're all probably familiar with them. We also know from other data that they employ the largest number of minimum wage paid employees. So we wanted to give Gabby the opportunity to question the company management about its labor practices, which has been in the media, including low wages and also safety concerns that many of the employees have experienced. Along with Gabby was a store manager, Kenya Slaughter, who's been using social media to draw attention to these issues, and also renowned human rights activist William Barber, Bishop William Barber, of the Disciples of Christ. He's also the co-chair of the Poor People's Campaign, which aims to lift up working poor in America. We wanted to share with you some of the highlights of our interview with Gabby to understand what happened in Goodlettsville, Tennessee, because the events were pretty dramatic. So we're going to start the video. Gabby, thank you for being here with us. What was your objective in traveling to Goodlettsville, Tennessee to the Dollar General shareholder meeting?
So the objective was to travel to the shareholders meeting so workers would have the opportunity to stand in front of the shareholders and voice their issues and concerns about their workplace. Some workers have been there multiple years and haven't had a raise. They're still making $8, $9 an hour. And as well as staffing, you know, you walk into the store. I'm a person that frequents Dollar General, Family Tree, all of that. And every time I walk into the store, there's always one cashier and there's a line all the way back to the freezers. And that's unacceptable.
What did you experience at the shareholders meeting?
So when we got to the shareholders meeting, we had a little rally outside in the parking lot as we waited for Bishop Barber, who was also one of the people with the proxy to go into the shareholders meeting. And so once Bishop Barber got there, he proceeded to lead a prayer. He led this prayer, and then we proceeded to go into the building. But once we got inside, they started to clear the table off and tell us that the board meeting had started and we weren't allowed in. And so Bishop says, what do you mean we're not allowed in? There's nothing on this paper that says that we can't come in after 9 o'clock. You clearly saw us coming, but you locked the doors, right? And so she says, well, this is procedure. The doors are locked at 9. Nobody is allowed in the meetings once the meetings start. And so Bishop says, I'm a shareholder. So at that particular time, he went to the door and he started to knock on the door. Open the door, let me in. I'm a shareholder. In the name of Jesus, open the door and let me in. And he proceeded to do this, I want to say a good 7 to 8 minutes. Bishop finally says, this is not over. We will be back. He tells Kenya, I will fly you to the next shareholders meeting. I don't care where it is. I will make sure that you are there and that you are heard. But I got a little so pissed off that I had to let them know. I said, do y'all understand that what you're doing is modern day sharecropping, right? The people that go in those stores look like me. The people that work in those stores look like me. But we can't afford to shop anywhere else because you're not paying us anything. So guess what do? We give your paycheck right back to you. That's modern day sharecropping.
The management team said that the reason why that you weren't allowed in the meeting was you were 4 minutes late, and they simply closed the doors. They actually haven't admitted to locking the doors, but they closed the doors and to start the meeting. How would you respond to their claims that that's why you weren't allowed in the meeting?
I think that's bull. I know they saw us coming up those steps. I know that they saw that Bishop was struggling because of the slight disability that he has. And I know that those doors were locked because when we turned the handle, it did not open.
Well, I hope you can see why we wanted to share this story with you. And I want to say that the story with Dollar General is not over. That we have continued to bring to them our disappointment with the way that this was handled. There's no way that legal proxies should have been locked out. And we're going to continue to make sure that Gabby and Kenya and Bishop Barber are heard. So I don't have an update for you yet, but there is a group within the Interfaith Center for Corporate Responsibility, a group of colleagues that are working on this together to address this situation. But we wanted to highlight it to you also because this is one way that we can work as responsible investors. We can use the power of being shareholders to elevate important concerns, and we weren't, they took their buses 11 hours from Louisiana to Tennessee. They weren't able to be heard at the shareholder meeting, but we're finding other ways for them to be heard, and we're going to continue to work with Gabby and others on this.
After hearing Gabby's inspiring story, probably 100% of the people on this call certainly understand how important workers' rights are, and fighting for those rights is something that United Church Funds takes very seriously. So thank you for sharing that story. For all of us that live in small town America, where there's a Dollar General or two seemingly about on one end of town or the other, that was a really important story and really eye-opening to those of us that see those stores, and now we know what the work is, the work that's happening behind the scenes. We're going to switch gears a little bit from sustainable and responsible investing to market performance. And as I do so, I want to remind all of the participants that there is a box at the bottom of the screen that says Q&A. You can use that to answer or ask a question. We will probably not answer those real time throughout the next few slides, but we will take a look at those and get to as many of those as possible on the towards the end of the call. Let's talk a little bit about investment performance over the last couple of quarters. Of course, we know, as Charles alluded to at the beginning of the call, that markets got off to a historically poor start in 2022. S&P 500 had its worst 2 quarters to start a year in over 50 years. And as we look at bond performance in Q1, bond performance hadn't been as bad as that in 40 years. As we look at the economic growth that we've really seen slow in 2022, let's think back to the second half of 2020 and into 2021, where we essentially saw a reopening of global economies. And at the same time, governments around the world, especially here in the U.S., were, jumpstarting those economies with trillions of dollars in stimulus. And so those two conditions, in effect, created almost what amounts to a sugar rush in the economy as we started to re-energize, put people back to work, and some in new ways. And we have started to see that slow in 2022. That economic slowdown has been exacerbated by some of the macro risks that we see around the globe, most notably Russia's invasion of Ukraine, as well as some other issues, including China-U.S. relations, supply chain disruptions, inflation, and tied to inflation, growing income inequality. As we all know, the impacts of inflation impact those that might not make as much money as some others, and more so. And so we understand that inflation and income inequality go hand in hand. Our team at United Church Funds has done yeoman's work over the last couple of quarters in protecting our portfolio from risk, positioning our assets in this volatile market in ways that hopefully benefit us over the long term, particularly in our balanced funds, using some cash and really using their ability to weight our portfolios equity versus fixed income in responsible ways. And as we look at the next slide, we'll get a feel for some of the environment that Dave and Lon and Menothi have been dealing with over the last couple of quarters. You'll see there on the left the calendar year-to-date returns for various indexes. At the top, you'll see equity indexes, and Matthew alluded to the MSCI ACWI IMI index, which is a broad global index of equities from around both developed markets overseas, developed markets in the US as well as overseas, and emerging markets. And you can see that index was down about 20%, S&P down also about 20% over the first 2 quarters of the year. Bond indexes, which you'll see in the middle of that graph, down somewhere between 10 to 15%. Some a little worse than that, some a little better. The only green number there in the calendar year to date was commodity prices, which, as we know, jumped in the first half of the year. And so, certainly commodity exposure would have helped a portfolio, as well as allocations to alternative asset classes like private equity, real estate, and others. On the right, you'll see the chart towards the bottom talks about the increases in interest rates that we've seen over the last in 2022, and certainly that has been a headwind for fixed income investors as well. As we turn to the next slide, I want to bring in my colleague Stacy Pettis, our executive of institutional relationships, who has a question for our investment team. And at the same time, I want to introduce Dave Clausen, Lon Kai, and Menothi Dhanaraj, who again have done a terrific job. Well, not only over the last 6 months, but certainly the challenges over the last 6 months have really shown their experience in these types of markets. And so Stacy has a question for them related to equity valuation. Stacy, go ahead.
Great, thank you. And thank you all for being with us. And I'll be posing this question to our investments team. We've been watching this chart in particular pretty closely over the past 8 or so quarters. And in late 2021 into early 2022, we saw U.S. equity valuations were very extended, with forward PE ratios of the S&P slightly above 21 times earnings. U.S. stocks became very expensive for investors, and simultaneously the economy was starting to slow, among other factors. So we're curious as to what are some of the other metrics or data points your team is watching carefully that help you and ultimately help our clients in determining next steps to position the portfolio for an economic recovery that we know will eventually come.
Thanks, Stacy. And I'll get started. We've got Lon with us, who's an expert in asset allocation and also quite experienced. I think Menothi is on assignment on the way to in transit. But thanks for the question, Stacy. Clearly valuations have gotten a lot better in the last period of time with the 20% decline, and PE ratios are more in line with historical averages. I think what gives us a little bit of pause, and the other factor that we're looking at in order for us to go overweight equities would be earnings. Really, can earnings come through in this period of time, even though valuations have come down and PE ratios have come down? Will the earnings support this level of valuation going forward? So far, the answer is earnings are pretty good. It looks like our earnings in the second quarter were up about 7% and revenues up about 13%. Some of that is due to the inflationary impact of nominal growth, but I think the important thing for us is to watch that level of earnings, see if it can be sustained, check the guidance, and make sure that margins won't be compressed because costs are going up for corporations, as well. The final point I'd make here is that we have not gone underweight equities at any point through the cycle. You saw Matt's earlier slide, which basically said that we had reduced equities slightly in the March rally. We're probably in the middle of a pretty good rally here, so we'll kind of see what happens, but we have remained at least equal weight in equities and balanced funds.
Great, thank you for that. I'll turn it over to Matt for the next question.
Sure. Thanks, Stacy. And David Lon, the next slide deals with inflation and interest rates. It's certainly a topic that we get a lot from our clients as we're doing portfolio reviews with clients that have concerns about their fixed income exposure as it relates to the Fed raising interest rates. They also have concerns around inflation. We often hear from the talking heads on CNBC, not the talking heads on our webinar tonight, of course, but the talking heads on CNBC. We hear this term soft landing, right? The idea that it sounds a little bit more like something that would happen on a windy afternoon at LaGuardia and less on Wall Street. But essentially this sort of controlled economic slowdown, if you will, the idea that the Federal Reserve and other government entities can sort of materially impact how we move forward, so that we don't spike inflation or have to dramatically raise interest rates at any given time. So my question to you is this: historically, levels of inflation that we're experiencing today have typically led to recession. But I think our clients would be interested to get your thoughts on this particular economic cycle, whether we're sort of in recession or not. The jury may be out on that, but in today's terms, how that is impacting your thoughts on the markets, and then secondarily, perhaps whether the impacts around COVID-19 make this sort of a special situation, if you will, sort of a one-off as it relates to how we think about inflation and how we think about potential economic recession.
Lon, I can turn that one over to you if you'd like.
Sure, I can comment a couple, and then so thank you for the question, Matt, and then thank you for having us here. First of all, we wanted the COVID situation as a one-off situation. Everyone wants it to be a one-off situation. Nobody wanted to see a pandemic again. And it was a one-off situation that you see a large amount of not only monetary stimulus, but also physical stimulus. And then also there is pent-up demand after a year or so with pretty much no consumption. And therefore the inflation rising pretty fast. There is a question in the chat room whether inflation is easing. Maybe we will see the number tomorrow morning at 8:30. From the last point is 9.1%. It is quite high. It's probably high since the 80s. And therefore, the Fed need to tighten the monetary policy by raising rates. And that will slow down the economic activities and the financial activities. So that's why when you talk about inflation leads to recession, it's usually that inflation need Fed action to control the inflation, and then by doing so, it possibly lead recession. And maybe we'll be lucky to have a soft landing. Now with that, I'll give it to Dave.
I think the tricky part is everybody expects it to happen so quickly and roll into recession like immediately. In the 70s, you didn't have the rapid fire of news, and so the surprise on the jobs front of 528,000 new jobs quelled, kind of recession fears for the time being. But we're trying to play the long game here, trying to position portfolios for the next couple of years, and making sure managers are positioning their portfolios managed for the United Church funds in appropriate long-term, long-term ways. But as Lon says, things are data dependent. We're trying not to get whipsawed at all in the portfolios by making rash moves here.
Appreciate it. Thank you, Lon and Dave. Stacy?
Yep, and flipping to the next slide, we all know bear markets can be quite painful in the short term, but eventually transition into bull markets. This slide illustrates the varying durations of bull and bear markets over to the right, and it also highlights that investors trying to time getting out of bear markets may pay the price of not being invested for the rebound. And so as we think ahead over the next year, what are a few of the macro risks you're watching that might bring a bull market sooner than expected or push a recovery further down the road?
Well, I'm gonna be a little bit flip here and say the unexpected. It strikes us, and we had a United Church Funds Investment Committee meeting, last night, where one of the questions from our investment committee members was, everybody is focused on the exact same thing. How do you add value? Everybody is talking about interest rates and recession, and things will play out the way that they will. Not to say that we don't have a view, but I guess, Stacey, I want to answer your question by saying, in the late 90s, which was a period of similar sort of excess, and then a rapid fire change, I think we'd be on the lookout for some systemic crisis. In 1998, it was long-term capital management, which was a levered hedge fund to the differential in rates, and we had the Russian crisis. So it's always something that investors don't expect that comes into play. And so that has led us to be relatively cautious on the equity side, not overweight, but amply weighted, and to still have a reasonably nimble cash position in portfolios. It's always something that comes out of to use a baseball analogy here, out of left field.
Got it. So really kind of expecting the unexpected, and we make adjustments where we can.
Correct.
Got it. Matt, I'll turn it over to you.
Well, thanks to you all. Appreciate the responses to those questions, and those three questions and those three slides are all come out of portfolio reviews that we do with clients. And as Stacy and I virtually go around the country and meet with our clients, those were some of the hot topics that were often asked, and we wanted to make sure that Dave and Lon had the opportunity to directly respond to those for our participants today. So thank you. So with that, we will transition to Q&A. We have a couple of different questions, and I'm going to make an attempt to ask these without putting folks on the spot to answer. We have a question from Arthur Clement. And Matthew, I don't know if you have any data, Matthew Ilian, I don't know if you have any data on this, but Arthur asks, what is the impact of Republican attorney generals in several red states who have challenged asset managers who follow ESG guidelines and who aren't investing in oil and gas and coal, et cetera, based in red states like West Virginia, Texas, Wyoming, et cetera? I think that question really does go more to maybe some more of the data that we can either share either now or maybe in future articles or blog posts related to these regulations against ESG investing by states on an institutional level. Matthew, any comment there?
Well, the impact has been a whole lot of confusion because they're sending questionnaires to these asset management companies, and they're even if the company itself has made a long-term net zero commitment to get out of fossil fuels in the long term, their argument is, hey, we're using this as good fiduciaries to avoid any unnecessary risks. And so, we haven't yet seen a whole lot of movement, to Arthur's question, in terms of moving assets from, one asset manager to the other, because right now they're, I think, just mostly collecting responses, and we'll see how they decide to move on it. But the divestment piece, that's a separate question from the ESG, and sometimes they get put together. It's one thing for Texas to say we don't want to invest with companies that are divesting. It's another thing to say we don't want to invest with a company that's using ESG metrics. So a whole lot of confusion right now.
Thank you, Matthew.
Matt, I just
Yeah,
want to
please.
answer one question that was showed up in the chat, not the Q&A, but it was on why immigration wasn't added to our list of topic areas. And I will say that first poll question, it wasn't meant to be comprehensive. However, immigration tends to end up be kind of combined with two areas. One is the engagements around private prisons and detention centers kind of get mixed together in terms of engagements. And then also worker rights. That's where, sort of labor standards, et cetera, is where the immigration piece gets set up, gets lumped in terms of corporate engagement. So I just wanted that, whoever put that comment in, to know that we are actively kind of considering that. Immigration is a big part of the conversation in our corporate engagements.
Sure. Well, thank you for that, Matthew, and thank you to the rest of my colleagues, the panelists on this call, for your time. I also want to thank the participants who joined us for today's call. I'd like to remind you that as we wrap up here, we try to keep these to 45 minutes. I think we've done a pretty good job of that today. I want to encourage you to share. You'll be receiving the recording for this. I want to encourage you to share that with others in your church or organization who might find this information beneficial. Maybe you have a committee in your church that really focuses on social justice and would be interested in hearing Gabby's story of their participation in the Dollar General annual meeting, or perhaps you have others in your church that would welcome the opportunity to learn a little bit more about how your church or organization's dollars are being invested for the long term. I want to thank everyone for being a part of the call tonight. I also want to thank you for the opportunity to be a trusted investment partner to your church or organization. We are grateful for that opportunity. We take that responsibility very seriously. And again, thank you for joining us tonight, and have a wonderful evening.